Welcome back to Guide to the Global Economy. I'm Josh Lipsky, Senior Director of the Atlantic Council's GeoEconomics Center. On today's episode, we're going to look at what's happening in Chile and their mining industry. We're also going to look at the Red Sea and the impact of Houthi rebel attacks and how it's impacting shipping. But first, I want to turn to Niels Graham, Associate Director at the Center, to talk about China's trade with the world. Niels, this was our lead this week. What did we find?
Exactly. So we wanted to look over the past few years, look at major trends, and it's really hard to talk about trends in the global economy without talking about China. So we want to look at the shifting trade that China's sort of been the actor with from COVID into today. And really what we found is real big shifts in who China's trading with, and particularly who's growing in China's trade. Who are the new traders that China's kind of engaging with over?
Let's take a look. We pride ourselves on interactive data visualizations. This is a good example.
Exactly. So really what we're looking at is an index over time of Chinese exports starting during Russia's invasion of Ukraine and the month afterwards, really until today. And the point is really to see, okay, where is China, where's the new trade and where's the new trade going? And who is trading less with China? And that's really what you're seeing with the green and the red over here.
And this is benchmarked 2 years back, essentially?
Exactly. Yep. Benchmarked to March 2022.
Right after the invasion.
Exactly. And really what you're seeing is the US and Europe really following through with some of the statements you're hearing out of their politicians around de-risking from China, reducing their export dependency on China overall. While at the same time, you see this real emergence of Russia and really Central Asia as well as a conduit of goods to Russia as kind of China's main trade growth. And this is really where we're seeing the marginal growth on Chinese exports up to now.
It's interesting because we spend a lot of time thinking about Russia's dependency on China, but if you see that chart, you see how dependent China is on Russia.
Exactly, and I think this is further driven home by recent dynamics happening within China's own domestic economy, where it's increasingly reliant on export-oriented growth. And if China's no longer able to rely on its traditional markets in the US, EU, Japan, sort of Northern Asia, it has to find new markets. And really that new market has first and foremost been Russia and the sort of Central Asian countries that Russia has been relying on to get goods into its own economy as the West also turns away from Russia.
How do you explain, there's so much skepticism about friendshoring in the US. We've written about this. Of course, Secretary Yellen gave the speech here 2 years ago announcing the friendshoring policy. But sometimes when we look at data, it shows that friendshoring isn't happening from the US perspective. But if we look at it from the Chinese perspective, as we saw it here, there's clearly some diversification going away from Chinese trade.
Exactly. I think a lot of the challenging dynamics right now with friendshoring is it's happening over the same time period that COVID has happened. COVID has really disrupted all economic data. You know, we had this amazing downturn right at the start as economies around the world locked down. And then throughout 2022, we had a massive boom in goods trade. So we saw China shoot up. And now we're seeing a dependency drop down. Part of this, again, is a normalization post-COVID. But part of this, again, is that sort of friendshoring dynamic where politicians are increasingly trying to pressure their companies to turn away from China. So both dynamics are playing out, and it's really hard to disaggregate which one is the dominant driver right now.
Do you think this is proof that friendshoring actually is happening more than we've realized before? We're kind of in this lead looking at friendshoring from a different perspective.
I think that's very fair to say. I think one thing that's really interesting with this graphic and the data that underlies this is it really looks at the marginal growth, of where it's sort of new Chinese exports going. What we see here is the really only main area of growth that sort of, at least in the long run for Chinese exports, is going to be Russia. You know, the US, Europe, even Japan, Korea, they've all, if you take kind of 12-month, or if you look over a 12-month time period, they're really reducing their dependencies on China.
This is a huge risk because, as you've written and others have said, China's manufacturing capacity is going into overdrive right now, not just on green transition kind of projects like solar panels, but a whole range of traditional manufacturing, automobiles, EVs as well. Where's it all going to go? It can't all go to Russia.
Exactly. I think that's the real core question right now. You know, we saw coming out of the National People's Congress, kind of the key economic policy event of the Chinese political calendar, that China's not going to turn towards other models of growth. Instead, they're going to continue manufacturing, they're going to continue to export. To export, you need markets, right? And the EU right now has an ongoing EV probe looking at electric vehicles kind of imported from China. It's very likely going to crack down on that. The US has already begun closing off its markets with large tariffs. Mexico has done the same, so it's looking to other emerging markets, BRICS first and foremost. But as we see, Brazil, 2 weekends ago, launched a probe into steel. India's looking at overcapacity. South Africa also looking at overcapacity. Really, Russia is the only partner China has that, at least on face value, is not yet turning against Chinese exports. So, we talk a lot about the dependency that Russia has on China in terms of being kind of its only supplier. But China's increasingly dependent on Russia to buy its goods and to drive its economy forward.
But it isn't the natural inclination then in the years ahead those goods would go into more open market economies with lower tariff barriers where they could, I'm thinking US, Europe, other places. I mean, if they're going to find an outlet, in theory it would be easier there actually than Brazil, but maybe that's not the case.
Yeah, but I mean, these governments are the ones that are intervening right now. You know, a 25% tariff is going to do a lot to reduce competitiveness of Chinese EVs, for example, in the EU. If you can move those goods then to maybe Brazil, to Southeast Asia, to Russia first and foremost, it's going to flow that way instead.
One thing I see from your research overall, and this lead in particular, is that if the middle of the 2010s, 2016, 2017, 2018, were the first trade wars, it's very possible, looking at this, the middle of the 2020s, we could be living in as dramatic, or if not more dramatic, trade war situation with China, because the manufacturing goods are going to have to go somewhere.
I think certainly, and I think that's why it's so interesting to look at particularly emerging markets. You know, emerging markets like Brazil, for example, that run a trade surplus with China. Brazil is sending more exports to China than it's receiving, but at the same time, it's seeing that China is taking on unfair practices, and particularly for these highest value industries. You know, China's new productive forces are capturing the same sort of goods that not only the US and Europe want to manufacture, but other economies want to. They want to grow with things like solar panels, with batteries, with electric vehicles, and so forth. And if China's subsidizing their industry using uncompetitive practices, then these other emerging markets have a choice to make whether or not they're going to continue to accept Chinese goods or close off their markets as well and ensure that they can develop their own industries.
Niels, we'll continue to look at this here at the center. Thank you so much for your research. Thanks for keeping an eye on it.
Thank you.
For Under the Radar this week, we wanted to look at Chile and find out what's happening specifically on lithium in Santiago and beyond. So I want to bring in Ryan Murphy, Program Assistant here with us at the Economic Statecraft Initiative, housed within the GeoEconomics Center. Ryan, what did you find?
So we found a really interesting development, Josh. So if you remember back to about a year ago, there was a lot of talk about Chile nationalizing its lithium sector.
Yeah, I think we wrote about it at the time. Yeah.
Exactly. So, and this wasn't actually true. There was a kind of caveat. So this is a 33-page report, National Lithium Strategy, and it said that the government had to have majority ownership for future projects going forward, which the Chilean state deemed strategic. And part of this was creating a national lithium company. Well, they haven't quite gotten to that part yet. They're still working.
33 pages feels like not that long for a national lithium strategy as government documents go, but I guess
exactly.
That's not the
They had
point.
pretty graphics and large margins.
Okay. Lessons for all of us.
Exactly, and this caused a huge reaction, specifically even from Elon Musk, who wrote that Chile's lithium sector isn't that important, which prompted a response from the Chilean Minister of Finance, who said, actually, yes, it is.
Yeah.
And it really, we do see this, that actually Chile is the second largest lithium producer in the world, huge capacity. And so
I hope this video isn't taken off X, but I think Elon's wrong. I think we could say that. So.
Exactly. And so the new development we see is just yesterday, Chile finally released its new sectors for development, new blocks.
Okay.
So previously, development had been limited to one Atacama Desert, and now these 26 new blocks have opened. And this is very important because new companies are really looking to develop and expand operations in Chile.
Okay, so what do we expect, and how has the U.S. been engaged here?
Yes, so part of the new stipulation is that, again, there's majority government ownership from Chile, and also there have to be value-added activities. And so in this case, China's really jumped on it. Just BYD just announced a $290 million lithium cathode processing plant, part of, again, EV production. But also the U.S. has been interested. So right after the G20 meetings in Brazil, U.S. Treasury Secretary Janet Yellen visited Chile and engaged in discussions with the finance minister.
This is just a few weeks ago.
This is just a few weeks ago. And part of the real sticking point is, again, Chile wants to move up the value chain, wants to develop cathodes and other elements of car batteries, but this might not be actually admissible under the IRA, the Inflation Reduction Act.
See, this is interesting. I remember that Sophia wrote about Indonesia, I think, a few weeks ago, and we talked about countries that really want to have more of the production domestically on these critical mineral issues. But then the question is about which companies come in to actually do a lot of the mining and the work.
Exactly, yes. And so Tesla's actually expressed some interest there, and now actually over 100 companies have expressed their interest for these 26 flats. So there is significant interest. In early April, India is actually going to send 2 delegations to Chile as well. So again, kind of looking forward, keeping your eye open on what are the companies that are going to be coming, what kind of bids are they going to be tendering.
How do they balance in Chile the national strategy here to keep this domestic in terms of domestic business, but then the international companies coming in and wanting to be a part of it.
Exactly, and part of it really is, again, this delicate balance. So Chile really needs this investment. At their current level, they would fall behind Argentina in 2027. And so they're really trying to encourage investment, but they, again, also really want to move up the value chain. Having these stipulations for value-added activities is one key way to do that, but also keeping your partners happy and not trying to discourage investment for a company, or for a country rather, that already has a 40% royalties rate, the highest in the world.
I think it's convenient in some ways that Brazil's hosting the G20 presidency this year, because I bet a lot of finance ministers in and out of their way to Brazil will be stopping in Chile given
Precisely.
this. So thanks for looking into it for us, Ryan.
Thank you so much, Josh.
For By the Numbers this week, I want to bring in Alessandra Magazzino, young global professional with us at the GeoEconomics Center. Alessandra, what was the big number this week?
Hi, Josh. So this week's number is 56.
56. What does that represent?
56 is the number of Chinese ships crossing through the Suez Canal in February 2024.
Let's see what that looks like when we charted it out.
So in this chart, we can see the total number of ships and the total number of Chinese ships crossing the Suez Canal since the beginning of the war.
And it's important to say we benchmark this going back to October to set everything at the same value so you could see the relative decline. Is that right?
Exactly. We are taking October 2023 as a reference. All the data here is indexed to October 23 so that we can really appreciate the change since the beginning of the war.
Right, and that helps you see the difference. And we had thought when we looked at this that it would be more Western ships that had dropped off than Chinese ships, given some of the statements that were made, but it's not what the data showed.
Yeah, so from this chart, what we can see is how the number of total crossings has changed since the beginning of the Israel-Hamas war. So the light blue line indicates the crossings made by all ships, while the dark blue line indicates the crossings made by Chinese ships. So, of course, the trend that we can notice is that there is a clear drop in the total number of crossings, and the drop is caused by the attacks made by the Houthis in the Red Sea. But interestingly, the Houthis, when they first started these attacks in November 2023, they openly said that they were a response to the Israel military engagement in Gaza. And because of that, they were targeting mostly ships connected to Israel, connected
Right.
to US and UK. But since the beginning of these attacks, they also declared that Chinese ships were not part of their targets. And despite this, we can still see a drop in the crossings made by Chinese ships.
And the reason we wanted to look into this originally is because of those statements. We thought maybe there's actually more Chinese ships proportionally than Western ships, US ships, European ships, but the data doesn't show that. So why is that? If they're not targeting, or at least saying they're not targeting Chinese ships, why is it dropping off?
Yeah, exactly. This is a very interesting pattern. Chinese ships are, transits made by Chinese ships are dropping. The reason for that may be related to the fact of that Houthis are misidentifying ships when attacking ships. So probably because of the export-oriented economy of China, they don't really want to take too much risk, and they prefer diverting their routes, going around the southern border of Africa, and therefore avoiding the Suez Canal.
So basically the Chinese don't necessarily believe that the Houthis can deliver on what they're saying in terms of not attacking their ships. They're skeptical and they're taking precautions.
Yeah, and this is very interesting actually, because a few days before our latest edition's publication, there was a deal between China, Russia, and the Houthis, where they basically agreed on avoiding attacks of ships flying the Chinese and Russian flags. But after our publication and a few days ago, actually there have been an attack made by the Houthis on a Chinese ship.
confirming the Chinese fears about this.
By mistake. So they are not totally wrong in fearing potential mistakes made by the Houthis. And this trade route is very important for China, especially for their trade relations with Europe. But again, they are not ready to take on this risk.
It's incredible, you know, thinking of what this rebel group, this terrorist group has been able to do to shut down a major transit lane in the global economy. And it's not just affecting one area of the world, and it's not just affecting the West or G7, as this data shows and your research shows, it's affecting every major shipping country in the world.
Yeah, and also the IMF managing director, Georgieva, actually commented on these disruptions happening in the Red Sea. And according to her, these disruptions didn't reach a level that is seriously threatening global economy. But the biggest fear here is that these disruptions may continue violence and in the area and continue conflicts regionally. We can see, so this is like the main consequence from a global perspective, but definitely from the point of view of China here, the main fear is mostly related to their relationship with Europe, their trade relationship with Europe, and also they don't really want to have their EV and solar panel sectors undermined.
Well, the good thing is we can ask Kristalina Georgieva about this and whether she still agrees with those assessments. She'll be here in 2 weeks talking about the state of the global economy ahead of the IMF World Bank meeting. So we will ask her about that statement. Alessandra, thanks so much for looking into it for us.
Thank you, Josh.
So Niels, before we wrap today, I wanted to bring you back on because this is your final episode with us in Guide to the Global Economy. You'll be leaving the center. Where are you going?
I'm going off to the U.S.-China Security and Economics Review Commission.
Dovetails well with the research you've been doing here.
Exactly. Continue to focus in on the Chinese economy, particularly China's internationalization of its financial system and its goods trade. So exactly the issues we've been talking about these past few episodes.
You've been with us here at the Atlantic Council 3.5 years. You've been a driving force behind the building of the GeoEconomics Center and Guide to the Global Economy. We have worked together closely on many leads. I can't even count how many over the years. And I thought it'd be fun to take a moment just thinking about some of your favorites before you head off. So for me, the one that comes to mind, and then I'm going to turn to you, was the weekend we had to work on Russia's reserves, which I don't think we knew at the time how long-lasting an issue that would be. But it was a Saturday. The announcement came, and we scrambled to figure out how to visualize what policymakers were doing.
Exactly. You know, it was definitely not how I expected to spend the weekend, kind of trawling through Russian central bank databases, really looking for where are these reserves. You know, we heard talk over the weekend that the G7 was going to freeze the assets located within their countries. And we really had this outstanding question, okay, how much is this going to affect? What is going to be the scale of the impact on the Russian economy overall? And to get that, we needed to first and foremost look at Russian data.
Yeah, and what people don't realize is the Russian data pre the invasion is really accurate. It was transparent, it was known for being useful from the central bank, and so we could draw a lot of information from that in close to real time, trying to figure out where the reserves were located, which wasn't clear at the moment. And when we put that chart together, this became one of the most viewed charts we ever did as a center.
No, exactly. To your point, you know, prior to the invasion, I think Russia was really trying to internationalize itself, really enter the global financial system. So its central bank had been very, very good at publishing a range of data sets. And through that, before they really started shutting it down, and I think that's the other really interesting dynamic that happened with that lead, is eventually the documentation that we used to generate that chart, to do the calculations that ultimately we showed in that lead, were taken down, and eventually other people put it back up. But, you know, it was that one weekend moment where I don't think the sort of Kremlin understood exactly how much data they had out there to allow Western analysts in that little moment.
Because we did it on a Saturday. The guide comes out on Sunday. This is the newsletter that this video is based on. And we called it Special Edition Rubles on the Run. And then we had some reporters on the guide list. And then Monday morning I was watching CNBC, and they said, according to the Atlantic Council, here's where the reserves are located. And they put that chart up. And I thought, wow, this guide idea, this might really work. So.
No, it's a perfect example of just a really clean, really simple. It's just a bar chart, you know, colored in a certain way. But it really drove home the point of exactly how much sort of assets they had available to them, how much were frozen, what is the actual impact of the G7 actions of freezing Russia's assets.
So what about on your end? Favorite guide lead we've done?
You know, it's really hard to pick. I think overall the guide is just a fabulously interesting process where you're really trying to take creative, sort of interesting ideas and trying to find data behind them. I think some of my favorites are some of the more historic ones where we try to say, you know, what is going on right now? Let's try to find a historic point of example to kind of get contextualized, to say whether or not we really are living in a unique moment or we're living in something that rhymes with history. And I think one that really stands out to me is maybe about a year and a half ago. This is really when Chinese lending, and Chinese lending is still a very big deal, but really back then it was China was kind of transitioning away from an active lender into someone who's starting to collect debt. So we wanted to see how unique is it, how that one country's provided so much different lending aid, and the sort of comparison that we wanted to do is look at maybe the Soviet Union. Let's see how much the Soviet Union impacted global finance, how it acted as a creditor overall, and what we really saw is that China just blew the Soviet Union out of the water as it's kind of competing now with these large multilateral institutions, whether it be the IMF or the World Bank.
I mean, that's one of the great things of the guide, where you take a step back. We always try to say, like, the historical comparison, and then where's the global economy headed? And if you try to say we're in a new Cold War with China and compare it to Soviet Union lending, it's night and day. And I remember when we wrote that guide lead, the opening, and I forgot this history, George Kennan's long telegram was created because the Soviet Union had not ratified the Articles of Agreement that they had signed at the Bretton Woods institutions. And so Treasury asked State, and they said, what's going on? And they asked Kennan for an answer by the Soviet Union, and he, you know, took 9 months and wrote back the long telegram. And the joke is always that Treasury never asked State for another memo ever since. So the things that come out of the guide process are always fascinating, and you've been such a driving force behind so many of them and brought creativity and intellectual capacity and really a way to look at the global economy differently, which is what the guide's all about. We'll miss you. We wish you the best of luck, and you're always welcome back here at the GeoEconomics Center.
No, thank you so much, Josh.
Thanks for joining another episode of Guide to the Global Economy. I'm Josh Lipsky, Senior Director of the Atlantic Council's GeoEconomics Center. We appreciate you being with us. We have a series of events coming up in the following weeks with IMF, World Bank. We'll host about a dozen finance ministers and central bankers. And as we mentioned in the episode, we'll kick it off with Kristalina Georgieva, IMF Managing Director, giving her curtain-raiser speech here at the Atlantic Council on April 11th. So tune in. You can follow all of it if you subscribe to our newsletter at the link below. Hit that subscribe button. We hope you stay tuned to Guide to the Global Economy.